Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, April the 22nd. I'm Jay Gragnani, and here joining me is Will Gibson. And hope everybody is doing well, staying safe and healthy as we continue to navigate the new normal, such as it is with the work from home, the stay at home as a result of the COVID-19 coronavirus going on. So hopefully everybody's staying healthy, staying safe, staying productive, and then also in addition to navigating the new normal in our personal and work lives, there's obviously the new normal that has been the stock market over the past couple of months. And it's been just over now 2 months since the market peaked back on February the 19th. And the new normal of seeing volatility still very high, as defined in a number of different perspectives, whether you're looking at just sheer daily moves of plus or minus 1%. It seems like every day, and just about every day, we've seen since February 19th, almost every day, we've seen market movements of either up or down 1% or more. Couple that with a VIX reading that is, while not where it was in kind of the throes of the big amount of volatility back in March, where the VIX touched at 85, and that's the volatility index, is currently in the low 40s, about 43 as we're recording this. So it's backed off of its high watermark by a good amount, although it's still twice the historical average. So certainly volatility is still very real in the market, in the stock market, but volatility has also become very, very real in the energy markets. And that's, obviously the big news event that has come out over the course of this week is crude oil May futures contracts falling negative. And that is something that, none of us have ever seen. And it's certainly a phenomenon that has caused quite a bit of volatility, quite a bit of noise across all energy markets, but also the stock market as well. And, when we look at energy and ways that the oil decline in oil and frankly, collapse in oil has affected a lot of different things out there, but, certainly affected a number of the crude oil related exchange traded funds. USO is probably the biggest and most widely followed. And the result of what has gone on in the energy markets has caused that fund to halt new shares and begin trading more like a closed-end fund, and get its methodology up to speed and in line with what's going on in the market and the reality of what it has faced with the markets. Because when you look at commodity ETFs, there's a number of ways that those products get access to the investments that they want to. It's either through the physical backing of the commodity, which is often the case in precious metals related products, things like GLD, that there's physical gold sitting in a vault that is backing the shares of GLD, or you go out and invest in futures contracts to gain exposure to that particular commodity, which is the case with oil, because the storage of oil is not like the storage of gold. So oil funds have to go invest in oil in futures contracts to get exposure to that. Then the second question is, which contracts do you invest in? USO is one that has historically invested in just near month contracts and rolled every month. There's other products out there that invest in 12 contracts across the entire calendar, so going 12 months out. Things like USL, which is 12 month out, meaning that fund will hold contracts in each of the next 12 months out. And then there's other products, things like DBO, which is an Invesco Deutsche Bank Optimum Yield Roll product. So lots of different ways to get access to crude oil there, and lots of different ways that the futures market has impacted the financial markets, because these products have become very, very useful investment vehicles for investors trying to get access to various parts of the financial markets. Nonetheless, one of the things to be aware of with commodity ETFs is how they're getting that exposure. In the case of oil, it's through futures contracts, and then how are they rolling those futures contracts. So just understanding, the ins and outs of those is certainly very, very important. And also the fact that, ETFs predominantly that invest in futures contracts are also going to generate K1 statements. So that's, just something to be aware of as you're looking and understanding what's going on in the futures markets underneath of those ETFs. But, outside of futures, the energy sector, obviously crude oil impacting the energy sector as a whole, the energy sector, Will, is one that has been under quite a bit of pressure for some time now, even before this week and all the noise that came out around crude oil.
Yeah, exactly. And just taking a brief look at that, we navigated to our Dolly page, dynamic asset level investing, moved down to our domestic equities group, and we note energy remaining last from a sector perspective. And again, for sake of time today, we won't do it, but another view to consider is through the history tab. And through the history tab, you can also get a historical perspective of where that sector has sat. So yeah, Jay, great timely commentary, I would say, as well as historical reference to note that despite all these moves, we're still seeing that long-term laggard from that domestic equity sector view. One more thing that I'll piggyback off here. You mentioned in the beginning a great deal about volatility, and there's been no escaping that for the most part in excess over the last month and a half, I'll say. And as a byproduct of that, we have seen a number of our indicators been shifting around. As if you follow us, I'm sure you're aware. One that we like to mention is on frequent occasion would be the bullish percent for the New York Stock Exchange. We'll navigate there now. And the bullish percent for the New York Stock Exchange, as a quick refresher, is going to be a participation indicator. It's telling us the percentage of stocks within the New York Stock Exchange that are currently on point and figure buy signals. Over the past month and a half of action, we've seen this move violently, going to extremely washed out territory in the single digits. And then we saw a violent upswing to the upside here, moving as high as 66% recently. And then as of a few days ago, we saw this reversed back down into a column of O's. Again, a byproduct of that volatility, as individual charts, which are building up the bullish percent, those individual charts have changed columns so frequently in the past, I'll say month and a half. There's a number of tops and bottoms that are close together and making it easy for securities to move to buy signals or move back to individual sell signals. So all that jargon, all that to be said, that volatility is clearly presenting itself in the bullish percent here. Nonetheless, it remains an important indicator and giving us an idea of field position. As we like to say, our indicators are maps telling us of where we are in the market. And furthermore, we can use that to look back historically. So again, did want to bring the bullish percent to your attention. We have seen that retreat, pulling back towards midfield territory again. One thing we have gotten some questions on in tangent to the bullish percent, I will say, is another short-term indicator as the high-low, also for the New York Stock Exchange. I'll navigate there. NYSE high-low is the symbol there. And we're getting some questions because if you follow us a lot, you'll note that we like to pair our indicators together, realizing that we don't have a silver bullet. We need to assess the weight of the evidence and look for confirmation on other indicators. So we see here the high-low reversed up into X's from low field position and currently resides at about the midfield mark, where we saw the bullish percent do a number of column changes and has since pulled back into a column of O's. Trying to bring the two together, one thing to note is the high-low is a 10-day moving average. So you're not going to see, generally, we're not going to see it move just as quickly as perhaps the bullish percent in this market environment. So one thing to represent there, one distinction to make. One other thing I'll note is that on that bullish percent, if I may navigate back, and this will pivot into a bit of a further discussion that we'll have. remember what's encompassing the bullish percent, or those underlying names within the New York Stock Exchange. We've seen a very small cap focus, I'll say, within the New York Stock Exchange, or tilt. Furthermore, there is a value tilt to the New York Stock Exchange as well. And in the current market environment, we've seen that large growth technology sector specific names have remained quite robust throughout all the volatility. And we see that noted, here on our asset class group scores page. Asset class group scores is taking all the groups on our platform and ranking them in terms of fund score. Fund score 0 to 6, 6 is the best, 0 is the worst. We'll note here that we see an equity core percentile rank of 84%, which is relatively high. Equity core represented by the S&P 500 index funds group, as we'll note down here in the 23rd position, sitting just below a lot of the fixed income names and more sector specific names, I will say. But again, kind of pairing those shorter term indicators together, we've really seen the volatility affect them, but nonetheless really evidence the strength in that large growth focus over the past month and a half, I'll say, throughout all of this turmoil, Jay.
Yeah, you're absolutely right, Will. And going back to the bullish percent for a second, that you mentioned the volatility that's seen, and that certainly has the last stay on offense, if you will, the last stay in X's was there for single digits. The recent reversal down had the bullish percent in X's for just a few days. And that's not common. I mean, on average, when you go back and you see reversals into X's for the bullish percent, on average, it tends to stay there for about 3 months, 86 days, strictly speaking. And so for it to stay in X's for only 8 days is very, very short. I mean, we have to go back to the 2008 market since the last time that we saw that. Nonetheless, to your point, it is certainly a very important indicator that we do follow, and the reversal down to O's or a move to defense is something that we should not ignore, and certainly something that should be taken into account. When you dig into that a little bit, though, and you look and see that the bullish percent is an equal weighted indicator, it is, as you mentioned, a bit more biased towards value stocks. It's also a bit more biased towards smaller and mid cap than large cap stocks. And so the names in this market that have been holding up have been those big mega cap type of stocks that you mentioned earlier. And so you've got a situation where the proverbial generals continue to fight the battle out on the field, while the soldiers have been moving down and have been giving sell signals. The soldiers being the small and mid cap stocks, the masses out there, while those big large cap stocks have really been the ones to hold the market up. To put that into perspective, if you look at just the S&P 500 stocks, so just the 500 stocks that make up the S&P 500, there are, through yesterday, nearly as many stocks that are in positive territory this year as there are stocks that are down 50% or more this year. And that's a staggering number when you think about it. If to the idea, the old investment theory of throwing a dart and picking stocks that way, in this market this year, throwing a dart, you have an equal opportunity as picking a stock that is up as you do as picking a stock that's down 50% or more. And so, that is certainly indicative of the market environment that we are dealing with right now. While you look underneath the surface and you see the S&P 500 certainly has corrected, but when you go in and you look at small cap indexes, you look at value indexes, those have been impacted, much worse, to the extent that we were talking earlier. If you look at like some value ETFs or value indexes, RPV is the Invesco S&P 500 Pure Value ETF, is down 40% this year, while year to date through the 21st, while RPG, which is the S&P 500 Pure Growth ETF, is down 15% this year, more in line with where the S&P 500 is. And you think, geez, how is that possible? And you drill down and you look at the sector exposure, and you see the biggest sector exposure out there is financials at about a third of that RPV of value. But you also see, so that, obviously financials, banks have come under quite a bit of volatility this year, as as has everything, but banks and financial companies have been impacted adversely, more so than other areas of the market. But then you also see almost 11% exposure to energy, and we all know what's happened in energy. We mentioned energy earlier, and so that's really what's gone on with. You look at a lot of those value names, you look at a lot of value stocks, and when you go and look at things like your asset class group scores, in the various views of that, and you see S&P 500 or core equity, that's really talking about a very small concentrated segment of the market. It is the biggest because it's big mega cap type of stocks, but underneath the surface, it's certainly been a lot more volatile than just the S&P 500 has shown out there.
Exactly. Yeah, that's great clarification, Jay.
And to the point, you look at obviously, we've spent quite a bit of time talking about equities, but fixed income, you see a lot when you scroll down this either that asset class page, or you look at within Dolly, and you see fixed income, cash and fixed income in the number 1 and 2 positions there, and fixed income actually is pretty close. It's just one signal away from moving up to number 1. Cash is still there right now. Fixed income is certainly battling, but then there's a pretty big drop off between number 2 and number 3, currency, and then domestic equity, U.S. equity, down in the number 4 spot. But it's been interesting within the fixed income markets. Here earlier in the year, you saw a massive de-risking within fixed income. Like credit spreads got really wide in the heat of the volatility. Saw a massive de-risking. We saw a lot of our models, our fixed income models, fixed income strategies move to a very defensive fixed income posture, with moving more low duration, moving more treasuries and away from kind of the risk on areas of the bond market. But now you're beginning to see some of that unwind as you look at, fixed income within Dolly, and you see things like preferreds and convertibles up there at the top. You see U.S. corporate bonds up there at the top. You see U.S. high yields up there at the top. And those are things that historically are more kind of risk on areas of the bond market, if you will, the areas that are less correlated to, less negatively correlated, I should say, to interest rate movement. So, just an interesting observation within the fixed income asset class, given, certainly, it is a strong asset class, relatively speaking, within Dolly, but it certainly is a very important asset class in terms of most investors' allocation portfolios. So certainly something to pay attention to and to watch and see how that plays out from here.
For sure.
And so, Will, with that, I think, I think that was a lot that we kind of unpacked there in a pretty short amount of time. Was there any one or two other things that you wanted to mention here as we were talking through before the podcast?
No, I don't think so. It is Earth Day, the 50th Earth Day I saw. So hopefully we can get and enjoy the Earth outside of our quarantine environments here later this afternoon. But market related, I think we've unpacked a lot here, a lot to process. So thanks for joining me here and sharing your wisdom per usual.
Well, that's right. So hopefully, we, as always, we appreciate everybody joining us on this podcast. And like we've said at the beginning, I hope everybody is staying healthy, staying safe out there. If you get a chance, I'm in my home office looking out my window, and it looks to be a nice day outside. I have yet to go outside today, but maybe this afternoon we'll be able to get out and enjoy some fresh air. So I hope everybody else is able to do the same. So with that, Will, appreciate you being on this week. Appreciate everybody tuning in and listening. As always, if there's anything that we can do to help you in your business, please don't hesitate to reach out to us. Our email address is dwa@dorseywright.com, or you can reach us by phone at 804-320-8511. Talk to everybody soon. Thanks.